it's been 11 years, I'm a full-time business angel. It's more that since you're very busy as entrepreneurs, and now there's so many different kinds of financing, is really making sure that there's a fit with the type of industry you're in, the stage you're in, and the kind of investors. And so where I would say, if there's only one thing I could say to not do, even though it's really tempting, it's people who will say, I just like you, here's a check, regardless of the valuation, and you feel great that now you've just given some shares at 2, 4, 5 million euro valuation, even though you're just starting. So I would say, if it's too easy, what?
No.
Is it okay?
Yeah, no. Just...
So that's the one thing. It might look like it's a gift. A lot of times it ends up being a poison later on.
Jeff?
I agree with that, but I'd give a slightly different perspective. If somebody is investing in you because it's sport for them, rather than because they actually believe in your business, you're in trouble. And it's amazing how many people who hold themselves out as angels or as early stage investors really are doing it because they're bored. They are often people who have made a lot of money or inherited a lot of money, and don't particularly want to be engaged at an executive level in running a business, but do want the sort of fun of being in board meetings and meeting challenges. And some of those people are fantastic, and some of those people add a whole lot. But those who see it as for their benefit rather than for yours can become a huge time waster and a huge value destroyer. And it's very hard sometimes to know, and we found this, we've made this mistake ourselves, distinguishing between those investors who are either going to be value additive, which is great, or value neutral, which is kind of fine too if they want to step out of the picture, versus the ones who actually are going to take up your time without contributing anything. So that's who I would avoid.
Well, I think that there is a very funny story about the smart money. And they say that the smart money is the same as bad money. So it depends very much on what you want to do and what you want to achieve. I think that one of the problems that you have as when you start a startup is to get a valuation that is reasonable, that you feel that you can get people that really understand why you are asking for that type of money. And the second thing, and I agree with both of you, is that certainly you need to look at people that are interested in the business, not people that say, well, I have $1 million and I'm going to put 10,000 in whatever it comes with, because then those people really are not going to help you. And at the very beginning, very often you need money, but you need advice and help much more than money.
Yeah, I agree. Well, I, as a representative of ENISA, which is a public company, I have to respond saying where to look for money, because we are a specialized company which offers a type of instrument. We can expand on it maybe later, but what we offer is a solution for startups, which tries to fit exactly to their needs. So I think the audience here know what we are, what we do, the type of instruments we can offer to the startups. And my first message would be have a look at the company and let's see what we can offer to your business.
No, but where should they not look for money?
Well, I think Rodolfo and the rest of the panelists, they have put the light on the point. They have to look for sources where not only the money but also the technical assistance and the information which is required to start a model, to start up a business. These type of sources, which are also under the regulation of the different organisms that we here in Spain have, the Bank of Spain, for example. So they try to avoid these solutions which offer short solutions or short-term solutions, and try to open the array of instruments and take into account all the instruments that the market and the public institutions we can offer.
Yes, I'm guessing that it's, as they say, look for the smart money, but essentially it's like, don't care about the money, care about what comes behind of the money. Now, because you have very different profiles. I'm going to start with you now, but I want you to get your input on your experience on what I'm going to ask, which is, how do co-investment with public funds, how do you see that kind of co-investment with public funds? Because I believe ENISA within Europe is actually pretty unique in the kind of conditions you guys give the money. And most people are very, they don't want to touch public money whatsoever. And we do know, those of us that move around Europe, how hard it is to get, especially European funds, because essentially they lock you down within that country. Okay, so what's your take on why should people take or co-invest with public funds? Are there any strings attached they need to know about? And your take on that.
Okay, I think we all understand that the Spanish economy is an economy with a very efficient banking system. We have great banks, and we do not want to compete with these banks. They do their job, and they do it perfectly in a very efficient manner. So we don't want to do what they are doing, and they are doing this job in an excellent way. We want to complete to attack to a failure market, because these type of business models, the startup projects, they do not find the needs, they do not fulfill their requirements because of the lack of a track model or a track record, because of the lack of experience. So we want to offer a first solution. And this first solution, we do understand that helps the second round of financing. So we want to start their business model. We offer a financial solution with our loans. And we think that with this first solution, with these first loans, they will be able to go to the bank, and with both the financial support and the institutional support, they will get an easier access to private funding. So we fully agree, or we understand that we fulfill this double objective, this double goal: financing and opening the doors to private institutions.
Yeah, I think that's a very interesting point, because it's true that there are some startups that are so unique and so rare because they come from deep research. It's very hard to get them funding. And you guys are actually, because I personally know several of those companies, that it was thanks to you guys that you gave them the money, that they were able to reach out then afterwards to investors with a much mature solution. So, and I do believe that Rodolfo has invested many times, co-invested with ENISA. So what's your take on that?
Half of our investors,
Half of your investors.
half of our investments have ENISA. And funnily enough, in Chile, we have investment from Corfo, which is the Chilean ENISA also. So about half of the entrepreneurs we back have funds from ENISA.
How is it working?
Very well.
Yeah.
Very well.
You're going to keep doing it?
Yeah.
Nice. Jeff, your take?
I have mixed feelings about public funds. I've seen some work really, really well, and I think, as a principle, the idea of allocating government money to something that is so productive for the economy is a very good thing. But we've had an interesting experience in the UK. Until about 2009, 2010, there were a number of different government-backed venture capital schemes. And their reputation wasn't great, and it's not necessarily a feature of public money or state funds in general. It's just they didn't work as well. And the shift we've seen in the UK in the last 5 years has been most of those have been wound down, and in their place have been extensive tax reliefs for private investors to claim back tax on investments they've made in early stage businesses. So in both cases, it's the public purse, just used slightly differently. And I think the fairly uniform view in the UK is that the tax reliefs have worked much better, that the process for raising capital has become much leaner and faster, that more capital winds up going into businesses, that the right sorts of businesses are being funded. And so I think that that's a really interesting example for a different approach a government can take to using the public purse to help support the startup community. That said, we are indirectly backed by Portuguese government funds. We have worked with a number of other government funders, and particularly, I think the UK may have been a particularly problematic case. And some of actually, we're at the South Summit. Some of the funds I've seen here in Portugal and in Italy have actually been very impressive, and I think may defy some of the logic I've just said. So mixed views.
Nice.
I'll just add two perspectives. The first one is what we see is whenever entrepreneur is raising financing from different types of investors, the entrepreneur has to make sure that we will work well together because we might have very different drivers. And so in some cases, the government funds might be very pushing for measuring faster and faster rate of growth of employees, whereas private investors might say, as long as equity value creation is happening. So I think they can work well if they're well coordinated and are aligned. The second thing is we've recently invested in startups that, for example, are supported by what is behind me, European Investigate, a great project. And a lot of times these entrepreneurs have gotten EU research money, which on one hand seems that's great, but sometimes as an entrepreneur it gets you used to just wanting more money just to do technology. And sometimes we have a bit of trouble because we're here to help build the business, not just to keep making a better and better technology. So that's where also this alignment can have a challenge because EU says just hire more researchers and we feel let's just go out, launch the business, and then we'll go back in the research lab.
That's very true. I mean, the whole coordination part, and I was just talking recently with someone about this, is don't think at any point that the fact that you're getting European money is making you sustainable. You have to reach sustainability on your own. You know, that's just buying you more time, which is great, but you have to reach sustainability. Now, this is probably a question. So I put, as I told you, a question for each of you. So the next question is definitely for Jeff, but you're going to start with answering your side from government perspective, kind of government representative. Yeah. We're going to touch on the crowdfunding. Very recently, they passed a new law on equity crowdfunding here in Spain with a lot of limitations, and Jeff and I were just talking about this. So first of all, what do you think about the new law and the fact that we have limitations on the amount of money that gets invested through equity crowdfunding when we do have a credit crunch in Spain to start with, and on the other hand, as a viable model for VCs to raise a fund via crowdfunding?
Well, first of all, we have to say that crowdfunding is a crucial instrument, and it is true that here in Spain we are a little bit in a delayed position regarding other countries where this instrument is very much more sophisticated and developed. So here we have a task to fulfill, and this precisely the law that you have mentioned, which is under discussion, tries to fill this gap. We are perfectly aware of the lack of an instrument and the regulation for an instrument which has to play a crucial role for startups in terms of funding these business models. It is true that, well, first of all, the law is under regulation. The final
it hasn't passed.
It has to be approved by the parliament. And here the regulators are trying to find the balance between the protection of investors on the one side, trying to adapt the different situations to different investors with or without a track record, depending on the assets, etc. And on the other side, we have to protect the clients, the consumers, in their prices. And in finding this solution, the regulators are trying to it sounds very politically correct, but it is true. At the end of the day, what we see is this sort of trying to take into account all considerations, and in having done that, maybe the law does not fulfill all expectations. Maybe it's true.
Yeah, I guess that when you try to please everyone, you don't please anyone. So, yeah. Rodolfo?
Well, I think the crowdfunding is here to stay. The law that has been brought out is not the best, but it's not bad. I mean, it's in the right direction. What I have a problem with is with crowd. I mean, you have to have a crowd. And to get a crowd is difficult in a country like Spain. I mean, the major platforms of crowdfunding in Spain have 8, 9, 10,000 people. And a crowdfunding platform really starts being active with 500,000 or 1.5 million. So that when people invest 200 or 300 euros. But here, the experience is that there are very few, and they have to invest 1,000 or 1,500, and that is not so easy in a crowd form. So in a crowd format. So what you have to do is that you have to get going, get platforms that have over 100,000 investors, and then you will get crowdfunding that makes really an impact. At the moment, there isn't, because the 6 or 7 platforms that we have, I think that the measure that is in the market has probably about 20,000 users, and 20,000 is still very low to be a crowd. I mean, the crowd starts at 100,000. So we will have to wait for another year in Spain to have a good crowdfunding environment.
This is interesting because I think Jeff can actually comment on that, both on the limitations and the origins. You started one of the first ones. So.
Yeah, absolutely. And maybe just a couple of words of context for those not as passionately committed to crowdfunding as I am. There are two kinds of crowdfunding. There's what Kickstarter and Indiegogo do, which is rewards-based crowdfunding. And for a variety of historical and probably right reasons, they fall almost entirely outside regulation. I mean, they are commercial platforms. You're buying a product, you're buying a reward. Financial regulation doesn't touch them, and you're not an investor. If you fund a project on Kickstarter, you don't get any economic exposure. You just get whatever reward they get. Equity crowdfunding is a form of investment, and it's in principle not that different from the type of investment that you would have had in buying shares on a stock exchange, although obviously with some very important nuances. And that's what Cedars does. We were the first regulated equity crowdfunding platform anywhere in the world. We spent 3 years figuring out how to do this in a way that met with both the letter and spirit of financial regulation. And we have thrived under a regulated environment. I think we are, depending on the measure, probably the biggest equity crowdfunding platform in Europe, and you know, we are at a point now where we have a critical mass. We had 2,500 people make an investment through us last month. We're doing about 2 million euros of funding per month, and you know, every deal we have has 200 or more or so investors. So it is something that we have worked very hard to get right. I think the key on regulation is that nowhere is the word balance more important than when it comes to regulation of financial markets, because the truth is that if you have too much, you crush innovative businesses. That we all know. But if you have too little, investors don't come to the market. And when we were building Cedars, there were others in the UK who made the argument to say, no, you really should have absolutely no regulation so we can all get off the ground quickly. And our response was, okay, great, so we get off the ground, but we don't have any customers. That doesn't help us either. And so getting that balance, getting that nuance right so that you have the right level of investor protection without crushing innovation is key. I think the UK has done a very good job of it, and I think that if you look at the regulatory regimes around the world, it is probably the closest, not perfect, but the closest to having the right balance. And one of the key metrics, or one of the key reasons that I think that, is that the focus of investor protection is not on how rich you are, not on how much you're investing, but on how you understand the risks of the investment you're making. Investing in startups and in growth companies is one of these weird areas where it's not complicated. Most people's mortgages, most people's insurance policies actually require more financial knowledge to understand than a startup. You invest in a startup, it does well, you make money, it doesn't do well, you don't make money. But it is very high risk, and you have to appreciate and know that in most cases, startups will fail. Even when they don't, you face dilution, you face illiquidity. And so what we developed and what has become the norm in the UK has been a quiz that our investors go through that shows us that they understand the risks of what they're doing. And if they pass that quiz, they can invest what they like. If they don't pass that quiz, they don't get to invest. It's very simple, it's very binary, and to us, that is a much more sensible and broadly applicable approach and balanced approach than saying 3,000 euro maximum for this type of investor or so forth. So getting it right is important. Focusing on understanding of risk rather than amounts of money is, I think, the way to do it.
Thank you, Jeff. That was awesome.
The thing that I would build on everything that's said is that countries where crowdfunding work well is where there's already a base of quite active professional angels, and they're the more passive angels that might go through crowdfunding, then in a way become co-investors. And I think that's very important for some countries are saying the starting point is crowdfunding. Personally, I think no. Build, like the UK, started it, but already had years and years of a very strong angel investing, which is the money and the support all the way to exit, because the companies go through lots of ups and downs, and if you have investors who can't help you all the way through, honestly, the money is fine, but it's just secondary. So I think when the two can work well together, crowdfunders and also traditional angel investing practices, that's really the key to success.
Can I jump in on that point a little bit? And this gets us a little bit back into the smart money conversation, but it's a point that I think people often don't think about in the context of crowdfunding, which is that there are multiple ways to help a business, and there are multiple things that investors can do to support businesses. And the classic angel model of being very involved in a comprehensive way in the business as it grows is one model, and it works very well in many cases. One of the things we're seeing increasingly, though, is that businesses come to us to raise capital because they actually want something different. Or maybe they want both. They're raising angel money as well. But they want the crowds behind them because the crowds provide a different type of support. Having a network of 200, 300, 400 people with a vested interest in your success who come from a range of different industries and a range of different backgrounds can have a massive amount of value as you're trying to build a business. And these may not be people who come in and sit with you day in, day out, or sit on your board, or really mentor you in the way an angel might. But there are people who, when you say, you know what, I really need a contact at El Corte Inglés. Does anybody know a buyer there? Sure enough, somewhere in your audience, somewhere in your base of investors, you've got somebody who does. And that is, I don't know if that term is smart money or community money. The semantics kind of don't matter. But it is a different type of value investors can bring. And that's becoming an increasingly important part, certainly, of what we do.
Oh, definitely. It's a signaling thing. Very different kind of signal that you send when you have 3,000 people behind your project. I'm going to do one last question. And then I'm going to open the floor for questions. So start thinking about questions. Don't make me yell at you because any questions? And no questions at all, okay? So last question, and it's actually for you guys. What would be a tip that you would tell a newbie, a tip to someone that just started doing their company and they're trying to raise money for the first time? What would you tell them?
Well, that's a question where you can say many typical things.
That's why we have 4 people. You can choose one each.
Well, first of all, to take into consideration, to take into account the different possibilities, of course. As I've said before, the banking system in Spain is very developed. And of course, it's the #1 solution for funding, for financing this type of projects. So let's have a look at it. But also take into account the different solutions that we from the public administration can offer. I don't know, maybe there are certain people who think that, okay, from the public administration, there are a lot of bureaucracy, long difficulties. We in ENISA, we try to be as flexible and as quick in the response as possible. We have a very close interaction with enterprises, with the firms, with the startups. We try to understand the model, the project. We try to adapt our financing and our products to their needs. So this interaction, which as I've said is very close at ENISA, we understand that this is one of our competitive advantages. So take into account all the possibilities, and of course not concentrate on one solution. Try to diversify the sources and to create a mix which fits to your needs.
Actually, I think the fact that you as CEO of ENISA, you are here and you're speaking perfect English is a clear differential thing about what you guys are doing, and that you're doing it right, okay? So that's great. Adolfo.
Well, I think that one of the big problems that you have, first of all, as an entrepreneur, is to find out if you have a company that someone will invest in. The majority do not.
Did you put it into a crowdfunding?
So about 80 or 90% of the companies we see are viable companies, but they are not companies that an investor will want to invest in. I mean, as you were saying, the majority of investments are a failure. So an investor is looking for something that will give him 20, 30, 40 times his investment. Now, if you have a company that in the next 3, 4 years is going to sell 300,000 euros or 400,000 euros is a company that might be viable. It might be money for yourself, paying your salary, and that's it. But you will not be able to get an investor. You do not need an investor, and you're wasting your time and the time of an investor. So the first thing that an entrepreneur has to do is, do I have a company that someone will want to invest in or not? And you look at your own figures, and very often, in the majority of cases, you see the progression and say, well, I mean, you're looking for 200,000 euros, and you're going to be making $1 million in 5 years' time. Where is the return? I mean, you're never going to get a return. So don't waste your time to go to an investor. I mean, you go out and search for customers that help you go ahead because you have a viable product. I always say that I invest in 5 or 6 companies a year, but I help create in between 150 and 200 companies that I explain to the entrepreneur, your company is not a company that any investor will invest in. Don't waste your time. Just think about who is your customer and try to get customers. Go out and make a company, make a living out of it. And obviously ENISA is a good companion for that because they don't mind. They don't want to have a huge return. They want their money back and a little percentage. So I mean, in their case, it's completely different. But a professional investor needs to make 20, 30, 40 times the money he's put because in 80% of the cases, he will lose the money. So if you don't have an investment that makes sense, don't waste your time.
I love how passionate Rodolfo is. Like, don't waste our fucking time. Make sure it's investable.
You know, I'm going to agree in part and dissent in part with what Rodolfo just said. Knowing your investors and understanding how they think is absolutely critical. And it does amaze me the number of times people present businesses where the whole presentation leads with how cool a product this is and what a nifty idea and how creative it is. And then the commercial elements of it and the how is an investor going to see a return comes at the very end. I mean, you need to be thinking from the moment you start talking to an investor that what they're looking for is how am I going to make money off of this, and speaking to that term. And you can talk with your coders and you can talk with others about how cool and creative you've been, but when talking with investors, it's critical to remember what they're looking for and how they're thinking. That's the part that I think we're probably all aligned on up here. The bit that I guess not disagree, but the slight color that I would add is that one of the things I found as the years have gone by is that different investors are looking for very different risk-reward profiles. Classic venture capital tends to be at one end of the spectrum. They see businesses as really needing 20, 30, 40, 100x in order to make it worthwhile to invest. They view the one business as needing to repay the entire fund. It's one particular way of looking at it. And if you're going to approach that type of investor, I couldn't agree more with everything that Rodolfo just said. One of the things we see in our market, though, we work with a lot of our investors are financial services professionals. They are exited entrepreneurs. There are many people from other backgrounds, including people who run funds and run other people's money, but just not in a kind of classic VC way. And they actually are looking for things that are perhaps a little bit more conservative, but potentially a little bit less upside. And a great example, I was at a new co-working space in London last night. And there are all of these, VC backable businesses there that are shooting for the stars but haven't really done anything yet. And in the middle of all of them is a new nifty t-shirts business that is profitable and has an amazing model where they get all the cash up front and then they make the t-shirts and they sell them at a huge markup. And is Sequoia ever going to come in and back that? No, of course they aren't. But there are a lot of other people out there who have no interest in the pie in the sky, what if this becomes Facebook mentality, but are thrilled at the idea of your cash flow positive? Great, let's do it. And so knowing who your investors and realizing different investors look for different things, I think is an important component of it as well.
Thank you, Jeff.
Now, I'm always last, but I'm sure it's because I have so many ideas I can always build on the great comments made. So I will say 3 things. The first thing is make sure you're really well ready before you start going out and saying, I'm raising money, because it's a bit like when you're selling a home. There's a bit of an implicit clock ticking. Secondly, we're going to want to do a bunch of due diligence on you. Make sure you plan on how you want to challenge us to see if we're the right source of financing for you. And last but not least, the best source of financing is customers. So we have, when we start investing, a lot of times, as soon as there's a little bit of money that is needed, it's like, hey, give us money again. We say, we're probably the most expensive kind, equity financing. You're giving a portion of your business. If you can just focus a little bit more on getting more customers or getting suppliers to say, pay me once you get the money versus you paying up front, is the best source of financing.
That was awesome. I think, Bridgette, you're going to come with me to other panels. You're the perfect panelist. 1, 2, 3. Awesome. You're going to come back next year. Don't worry. So I'm opening the floor now for questions. We have 7 minutes. So first question here. Guys, to the point so we can get as many questions as possible. Thanks.
Yes, hi. This question is for Bridgette.
Higher.
As you are familiar with European scenarios of funding from European Commission and so on, you talk about having a lot of researchers really focus on research instead of going to market. So let's say the opposite. How do you think European investment look for a company that's really focused on getting to market with a product and that is using technology and innovation in an innovative way, but the product is technology is a tool.
Enabler. It's an enabler. It's not the end. Yeah.
Exactly.
What is your question?
Because what I see from European is that they are more focused on
Question.
technology,
Question.
not on
Question.
usage
Okay.
of the technology.
So it's changing. So the good news, I think, at the EU level, because I also work a lot on policy, and the project behind me, we're just as much looking for businesses that are leveraging technology as much as pure technology. So it is changing. In Horizon 2020 is much more focused on those things, even social entrepreneurs.
Yeah, I can say we know, actually there's a bunch of people here that have won Horizon 2020 European Commission projects. You should talk to them because they're very goal-oriented, using the technology as an enabler instead of the end goal. Another question. Come on. People at the back. I gave you time to think about questions. I have a question here.
Can you sit there?
This is a question for all of you, but specifically Bridgette. How many business angels are there in Europe compared to the US? How many people? How many people are we counting?
I think right now, as ex-president of EBAN, we estimate close to 80,000, 100,000, versus the US, which is now over 300,000 investors. What's most important is we still invest less per business angel than in the US. And personally, one of the reasons I'm full-time in Europe is because I think we have much better raw innovation here. The key is we need a lot more business angels who can turn that innovation into successful businesses.
I'll just share, I'm not going to challenge Bridgette's numbers, I'm sure they're right, but I'll share a slight observation. One of the reasons we wanted to focus, at least initially, Cedars on Europe, or the UK and Europe, is because wealth is generally distributed somewhat differently here than it is in the United States. And in the United States, to be a business angel, you have to be really pretty high net worth by and large. In the United States, you get a lot of rich people and a pretty big gap of between them and everybody else. Europe, due to a whole number of reasons, has a much broader middle class, has a much broader group of people who perhaps aren't quite wealthy enough to be business angels in the classic sense, but do have capital they can invest and want to invest. And a big part of what we have targeted as a business has been that mass affluent who aren't quite wealthy enough to be full business angels, but nonetheless have an interest in the space.
Yeah, in our network with 50,000 euros as overall budget, you can be a business angel and make about 10, 15 investments.
Any comment, guys?
I think that the problem that you have in Europe is that we are just far behind. I mean, if you look at the UK is probably the largest country in business angels in Europe, percentage-wise. Now the second one is probably Germany, that has grown very rapidly in the last couple of years.
Germans, they have everything.
And we are probably in Spain only starting. I mean, if you're talking about 80,000 business angels in Europe, in Spain we won't have 400. No. I mean, we have 4,000 potential, but that really have invested
Yeah,
in technology, no more than 400.
really. And yet there's really good deals here, so this is where we should come and invest.
True fact, because I'm pretty sure Rodolfo knows them all, actually. So, any other questions?
Hi, I have a question for Jeff. Regarding the equity crowdfunding framework, how do you see the approval of the Title III in the Jobs Act in the US? Are you seeing positively? Is it eventually going to arrive, or how are you seeing this?
That's a very good question, and just for context, quickly for everybody. So the US, about 2.5 years ago, passed a law to allow equity crowdfunding, and it has been sitting on the books but not been implemented by the regulator yet, and nobody knows when it will be. And the truth is, it's a total cluster, you know what. I mean, there are so many problems, both with the statute as written, and then with the way that the SEC is looking to implement it. And I think they know that. So I don't think we're going to see, my guess is, my crystal ball is, we're not going to see it implemented before the end of the year. And I think that in the next Congress, particularly if the Republicans win the Senate and hold both houses, we're probably going to see a whole new piece of legislation that overturns Title III and does something different that makes it workable. That's my prediction, my hope at least, actually. But, you know, anything can happen. It's been a real disaster in the US. And actually, I would say, you know, as Europeans, I'm American originally, but as those of us who've built our lives and careers in Europe, we should be really proud. I mean, Europe is way ahead of the US in this particular area of finance, and it's been a tremendous accomplishment.
Yep. We're going to give you the European, you know, ID card. Don't worry. You're one of us. Another question, please. Thank you.
Good afternoon. Just a personal question. My company is Relevante. We just got a seed capital from ENISA, Joven Emprendedor. Then we got a Neotech that we just received, and we are now building the team. In 6 to 9 months, the product is almost ready. We'll need to have traction metrics. Would you advise to raise money locally or going Europe-wise around London or what?
I'm not sure if I fully understand, if I fully understood the question.
So they raised money with you guys several times. Now, the next round they raise, should they raise it locally or should they co-invest or raise it elsewhere?
Well, it depends on the needs. I mean, our purpose is to offer a continuous solution, a continuous financial solution. So the fact that you have already got one of our loans, it does not presume that you're not able to attend to or to come to us and ask for another round. So we are, in fact, our purpose is to accompany the company along the development process. So we will be more than happy to analyze your second proposition. But of course, the instruments are on the market. You have also the VC firms, which will be able to analyze the project, and of course.
Well, it depends what you have invested the money of ENISA for. I mean, if you have really got already some traction, you might want to find big money at a high valuation, or you want to get fast money and then you have to do it locally. So it depends very much on the speed and on the traction you have got. It's very difficult to get someone outside of Spain to get investing in a company that has no revenue, that has practically a business model to be proven, that has already a debt with ENISA of 75,000 euros. You will need someone that understands that, and that is normally a Spanish company.
Is it right?
Last question.
Yeah, I got a question for Rodolfo. In average, how much is the time that passes since the moment you start to have conversations with the company you might be interested in until the moment you actually invested in? You know, with the due diligence and everything. And in general, for the rest, which is the average time you would advise for companies to start to look for funding?
Well, in our case, I mean, the fastest we've ever done it is in a week. And the longest is 6 months. So it depends very much on the entrepreneur, because we are very early stage investors, and very often we talk to people that are still dealing with the idea. They haven't got really exactly what they want, And they ask us, after they meet with us, they say, well, let me have another 2 months because I need to answer the questions that you are making. I need some thought about it. So very often they come back in 2 or 3 months' time. So I mean, the shortest is in a week because they had it very quick and we knew what we wanted and they knew what they wanted. That's the shortest we've ever done it. And the normal is in between a month and a half.
We're the same way. It depends a lot on connectivity and how well things are prepared. One thing to be aware when we talk about the timing, there's the due diligence and then the negotiation and actual transaction. And depending, we do deals in about 8 different countries, and in some countries we might agree really fast, but actually going through the whole process until you have the money in the bank can be 6 or 8 weeks.
ENISA, any comment?
Well, regarding the process and how much time do we need to analyze the operation and to have an answer and to respond to the question, it depends on the quality of the information we receive from the company. We don't ask for any guarantee, we don't ask for any collateral, so we have to analyze the project, we have to believe in your project, we have to understand your project, and
minimum time, maximum time?
Minimum time, 1 month, maximum time, 2 months. But it's very difficult. It depends on the project, it depends on the quality, but let's say between 1 month and 2 months.
Okay. It's actually a stark contrast. How many of you here know Dave McClure? Some of you? Okay. There's a bunch of stories about Dave handing out 25K in a cab. Like, okay, there you go. Amount, minimum time, the cab drive to the airport. So, guys, thank you very much for being here. It was a pleasure. Thank you, guys. Big round of applause. Come on.